Chris, good evening.
Good evening, Tusif. How are you this evening?
Been good. How about yourself?
Doing quite well, thank you.
Awesome. It's interesting that we have had 15, this is our 15th episode together on the Tax Layer series.
Wow, 15. Wow, that's longer than some of the seasons coming up for the TV shows because we didn't go on strike.
Absolutely. But for our viewers, we have been helping people with their some of the questions with taxes. But tax filing season right on the corner. For 2024, IRS is opening up their e-filing portal around 29th, if I remember correctly. Yeah, 29th, Monday.
29th.
So both myself and Chris are going to be extremely busy between 29th and April 15th. But before going into our caves, I wanted to come up and invite Chris to actually discuss what most of the summaries, how we can actually get prepared for the tax filing season. Chris, walk us through towards the summary of course, what happens in this season. What can people do to maximize their efficiency so that it's best for tax filers and great news for the people who are filing the taxes?
Well, the first thing is most accountants are going to send you a checklist. Tusif and I have checklists. And what I always say to people is, look, if you have questions on there, we know that we go into accounting ease. Tusif and I have certifications in this, and so we talk about this all the time back and forth. And my wife and I work together as well. So dinner table conversations is about taxes, much like the Ripkins talked about baseball back in the day. So please ask, if you have a question about something, ask your CPA, say, hey, this doesn't make sense, or what exactly do you need from here? And if they give you the, just so stupid on this, maybe it's time to find another CPA and fire that guy because you want someone to talk to you. We are here to help you. Tusif and I are trying to save people, was it $10 million on taxes, Tusif?
Yes,
We upped
this
it?
year.
Yes, indeed. So we're trying to do that. So we are interested in what you have to say and what questions you have. So make sure that you have a checklist, go through it. And if any questions pop up, no matter how crazy they may sound, ask because most likely it may be that something we are not being clear about so we can change it to make things better for other people. So
Yes,
work the checklist and just let us know what questions you have.
awesome. As a matter of fact, if there is something that is legal, ethical, and if your CPA or tax professional saying they don't want to take it just because of their gut feeling, not because of a legal reasoning, maybe get a couple of other opinions because as interesting note today, I was talking to one of the gentlemen. The reason for him to consider other CPAs is he's figuring out there's something called home office deduction, and is his CPA saying no, he shouldn't take it. I'm like, yeah, I mean, as long as you have the data, as long as you have kept the proper records with Chris's 5 commandments, document, you follow these 5 commandments, you're still living in the US, folks. It's not North Korea yet. So definitely reach out to a couple of other opinions and we'd love to help you out as well.
Yes, indeed. I agree with that. There may be something underneath the reasoning for not filing the home office deduction. And with a home office deduction, you got two ways to do it. The simplified method, which is $5 for each square foot. But for the actual drawn out one, part of that is taking a depreciation on your section of the home. And
Yep.
maybe they're sitting there thinking, well, maybe you don't want to take depreciation. Well, you as a taxpayer get to decide whether or not you want to take that and use it. You have the right to say, okay, I want to take this, and don't CPA shop, but just make sure that it's a valid reason for why they don't want to do it. Otherwise,
Yes.
yeah, talk to somebody like Tuesday for I.
That's why I said that get a couple of opinions. It's not about shopping for CPA. It's about understanding the reasoning. And of course, as Chris is mentioning, reach out to the CPA to understand the explanation. We love helping out understanding because at the end of the day, this is your money.
Yes,
Uh,
indeed.
the tax you're paying on is your money. It's not government's money. It's not our money. It's your money, and you should have the say to it. And there are things that might be different as well. And there's reasoning for different approaches as well. Like if you were in, say, for example, San Diego, California, your house per square foot is going to be significantly more advantageous to go the regular route as opposed to maybe somewhere in Alabama where you're enjoying the best of having a very affordable housing situation where you probably are buying it 30, 40, 50, $70,000 and saying that, hey, if I do, even if I did depreciate, it's not going to be much. So there
Exactly.
might be reasoning for each one, but definitely ask the question. So I know we had 14 other episodes. I would love to quickly skim through some of those and get a couple of minutes from Chris as well. So the first one we did was in corporate structures. So whenever you're doing, let us know what if you or whoever you're working with, let them know what you're actually structured with. One of the
Yep.
biggest things people mix out is whenever they're having LLCs that are taxed as S corps or C corps, tax wise, you're actually an S corp or C corp, even if you on the Secretary of State it is LLC. So make sure to understand that with your CPA. So Chris, what do you typically see from people regarding those confirmations?
Well, normally what I ask for is that do you have a business and I want to get the confirmation of your EIN. And on that, there's a little section that says use this tax form. So we use the tax form that they say to use on that. So it's really important that you have that with you so that you're able to give it to your CPA and make sure you do that as early as possible. Because one difference between a single member LLC and an LLC being taxed as an S Corp or partnership is the due date of the tax return. Because everybody knows that April 15th deadline for an individual tax return, which includes the single member LLCs, but the S Corp and the partnerships are due March 15th, and you don't want to find out on March 13th that, oh, no, I should have been filed. No, it's a C Corp or it's an S Corp or partnership. I need to get a tax return done in 24 hours. So we would not be very happy with you. So take a look at the form you got confirming your EIN, employer identification number, saying you are this type of business, use this form. That's what we're going to need from you to make sure that you get the right tax forms filed.
That's awesome. And as a matter of fact, last year on September 30th, I had someone with an S corp owner reach out to me that, hey, I have time till October 15th.
Yeah.
I'm like, yeah, you have your personal one, not your S corp. So that's what happens most of the time, especially with people saying that, hey, April 15th is a deadline. Many people are so busy making money, they forget that to read that EIN, and that deadline is actually March 15th and September 15th, as opposed to April 15th and October 15th. I know, yes, last year there was a little bit of difference for the people of state of California, but other states did not have that any kind of exemptions like that. So the next one we actually did about corporate record keeping. Of course, this is so important that Chris has made this as commandments. So
Yes. And we'll go
definitely,
over them again. Top 5 commandments: document, 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 document. Make sure you're able to back up the numbers that you're putting on your tax returns. I've been to 2 audits. One, the client breezed right through because we had everything all lined up. The other one, well, we kind of had it. Well, no, we actually didn't get it from the company, and then they ended up not really having a very good day with the IRS. So follow those 5 commandments and make sure that you're able to back up what you're going to be giving your CPA. We don't necessarily need all the receipts. Keep them handy, but we don't need them. And
absolutely.
the length of time for keeping things, 3 years. Turn
Yep.
that to 3 years.
So the 3 years is when you can, so the same time that someone can go ahead and file an amendment is the same time that you have to keep them for. Now, I know there are certain, there's a few exceptions to this, is if you have real estate that you're going to be eventually selling. The reason for that is if you have an asset that you're going to be potentially selling later on, you have to keep it as long as up until the time you're selling it. Because, say, for example, you're keeping it at 30 years ago, it's a 30-year asset. Say, for example, for real estate, it's 27 and a half years, residential side. If you don't get it, someone might come in and say that, hey, you're going to pay taxes on much higher amount as capital gains than you should have been. So that's one of the exceptions that I would definitely recommend people. Another thing is if you have something that is liability associated with it, that is more than 3 years. So if you have a receipt, say, for example, you did a service that you put a 5-year warranty, and then someone at fifth year coming back to you claiming that, that's a different thing. Now you're actually going back and going to that accounting system. So unless you're having that, typically at least keep them for 3 years. And another thing I would recommend is make sure to keep them well organized for your CPAs, because your CPA is probably not your bookkeeper in
Yep.
many cases. And one of the things that if you are going to them and just giving them a bunch of numbers, even you don't know what those are, he's probably going to push yours than other ones who are much better organized. And another thing, as Chris was mentioning, we don't need to have all of the receipts. On our side, we are obliged to ask you decent questions as long as we feel that you have a reasonable stand to believe that what you're saying is true. That's how due diligence is done. So legally, we're off the hook. But if you're lying to us, trust me, you're going to if there is an audit, you're going to end up in a very sticky situation with IRS. So that's why we always recommend keep your receipts, have things back up. And as I mentioned, there are times IRS also lose cases. So those are especially for the people who are keeping their good receipts, good documentation. Awesome. The next one we actually took was to discuss on the third episode about taking the money out. So this is another interesting thing. When, say, for example, even between me and Chris, we have different structures. So it's going to differentiate between how we're taking money. And each of us has, there's nothing the best or the worst. It's for every single one is individual different. So you need to decide on what you're going to be doing. And as consultants, we can actually help you give your options. But at the end of the day, as a business owner, you need to decide what you're going to be doing and taking the route. Chris, what do you have to add in this particular section?
Well, too, so if I think you hit the nail on the head, it really depends on what your goals are with the business and what you're thinking about doing going down the road as to what structure you're going to set up. And so, how that affects the money that you're pulling out. So really, it's just a matter of not saying, well, I've always wanted to own a big corporation, so I'll be a C corp. Well, you haven't sold one piece of anything yet, so why are you getting started with that? Make sure you have a viable business idea, but sit down with your CPA, because you can change things over time.
Yes.
So take a look at what your situation is now, not where you hope to be. Yeah, aim for the stars, but make sure that you get a running start to be able to jump up there like Superman.
And I'm personally a living example to this. In the last 6 years in my US life, I've started almost 7 businesses, lost 4, and made money in 3. So when I was starting first out for the first few ones, I was like, hey, I'm gonna kill it. And we were doing so many things in terms of structures, and so come on, we ended up losing money. And this is not the technical loss. When the technical loss I mean is I'm showing losing money just for the heck of tax burden reduction. It's not that loss. It's actually losing money. And in that case, C Corps is not actually helping, because all the money lost is essentially stuck within the corporation, as opposed to a flow-through entity in some cases. But I actually personally learned how to grow myself. So don't make the same mistake I personally did. So one of the biggest aspects of learning in the society is learning from other people's mistakes. And if you don't learn to do that, you're going to be ending up making so many mistakes. It's going to be really tough for yourself.
Absolutely.
So then we actually went, another thing before moving off of this topic, we actually discussed about paying your kids, one of the most important thing. But one of the things that a lot of people miss out here is if your child is you claiming as a dependent for other purposes like CTC, ETC, earning EIC, not ETC, EIC. You need to realize that for dependents, that's actually 4,400, not the 13,000.
Good point.
So a lot of people like, hey, I have been paying my kid as 11, 12,000, and he's a 4-year-old for giggling in front of the camera for marketing purposes. And I understand that, but remember, you were actually claiming him for other places for as dependent. So that actually changes the limit, and you're actually exposing him to other tax burdens and potentially bringing that money back to your tax return as well. So make sure you understand that distinction. Excuse me. Next, we actually discussed about real estate. So I'm gonna concise about few episodes here. Is we spoke about different strategies when you're buying it, but you don't have income. That's a different story than when you're actually putting that into service. Chris, help us understand. So say, for example, someone bought a property, it formed an LLC, bought a property in December. He wants to do it for a rental, but with the process, fixing, getting the previous tenants out, previous people out, it took him to February. Does he still have to file and pay any taxes on previous year, or how does that work out for him?
Well, if he doesn't have any income in the year, then no, there's nothing really to be filed. It's going to be the year when you have income coming in that you're going to do it. Now, there may be some costs that you're able to take because that you set it up and your intention was to have a rental property and have it out that you'll be able to take. But for the most part, no, until you've got the income, that's not a taxable event.
So that's a great point you brought up. Two aspects of it. If you don't have income, you're not having any tax liability. But just because you're setting it up, accruing assets, you might be subject to some deductions. So depending on how it's structured, some of that might come to your personal income. In some cases, there might be some limitations with the passive loss, activity loss and stuff. But many of those Schedule C income is eventually going to come to your personal income. And you have a certain threshold to at least for the first year to write off against your income. Or
Yep.
more like the startup costs, if you want to put it like that.
Yes.
For the business income. Now, talking about the real estate, of course, whenever you're having real estate, there's different ways. We discussed about subject to seller finance, wraps, depending on what strategies is it, lending. A lot of people also talk about catering, and also partnerships. So, and to be on a very broad summarizing it, there's a couple of things associated with it. Is for real estate tax, if you're buying it, you have property taxes. Some of the property taxes might be subject to deduction because if I remember correctly, it's 10 grand for the personal residence as well when itemizing your expenses. And depending on how you're taking it and what your purpose is, if you're flipping it, that's an inventory. So you're not actually able to write off the expenses up until you sell it. But if there's an operations going on, there's a different story. So understand what categories you're falling into. And again, if you're doing an arbitrage, which is lease option or something like that, or a lot of the people call it a sandwich lease, that's a different element. Like for you, on the acquisition side is an expense because that's a rent, unlike a mortgage, which would have been a depreciable element as opposed to a write-off, because now that is a rental expense, while if you were to own it, that becomes a depreciable asset as opposed to a write-off. And of course, your income becomes irregular income depending on how you're structuring it. Anything to add here on the real estate side, Chris?
No, it's just if you really covered it all on all of that. So I'm going to leave it there.
Awesome. So now going into actually we covered from literally 4 to 7, especially one of the few things people can include and indicate is the short-term loophole. A couple of the key pointers is this is actually per property. It does not, just because you had 100 hours on one property does not have you qualify for the other properties. But the good thing about this is you can take it even if you do have a W-2. But for the reps, if you have a full-time W-2, for the 750 hours, ours is sometimes more, even though theoretically you can, because if someone works outside of office hours, 9 to 5 to work and 5 to 10, he's still going to be able to do that 750 hours, but ours is typically not very happy and comfortable allowing it. So if you're into that position, recommend looking into having your wife qualify or spouse qualify for that.
Mm-hmm.
Still have both of you qualify as long as you guys are legally married.
Yes.
So
make sure you keep track of your hours. Make sure that you're doing that and keep track of her hours too. Or I'm sorry, spouse could be. I mean, we have ladies in the audience who are going to be watching this, so make sure your husband keeps track of his hours if he's working for you.
Absolutely. And a couple of the basic things that needs to go into that is the property, why he was working with, the description of the job, what he was doing. Someone just kind of say, hey, I was just hanging around with my friends and I want to have that as a deduction. And then the time, how much time he actually spent, the date when he did it, and the business purpose. Because everything that we have been doing, as long as it does not have a business purpose, it's not deductible.
Mm-hmm.
And as long as something is ordinary and necessary for business purposes, it is deductible. As a matter of fact, one of our clients actually asked us a very interesting question. Hey, if I'm flipping in a hood, can I buy a gun? And, hey, this is for ordinary and necessary for the circumstances. But if you're like Chris's favorite example of alpaca example, alpaca or alpaca, whatever. Actually having my words mixed up. So maybe if you're having a childcare business and if you're saying that, hey, I want to buy a gun to protect myself from children, that's a questionable element. So understand what is ordinary and necessary in your line of business, and we can definitely look into that. Chris, you want to add something to it?
No, I was just chuckling at having a gun for if you're taking care of kids. That's not going to be a good idea. So that would not be ordinary and necessary because the IRS really will look at that. And as I say, if you're like a tutor or something, and you say, well, I want to buy a Maserati and use that in my business, the IRS is going to look at that very closely and say, what does a high school tutor need with a Maserati? So when you're making decisions about these, it's ordinary and necessary. Don't use this as saying, well, I can use this as my personal bank to get away to living lavishly and writing everything off. So be careful with that.
Absolutely. And again, couple of interesting things that people can look into is, especially what Congress is pushing people towards, is renewable energy. Like you might get a energy credit if you're a business. You can get a solar credit, a renewable energy credit if you're a personal house as well, up to 30%. And in some states, they have state incentives as well, especially in California. So if you guys have it, and even if you guys have Tesla or Lucid or any of the full electrical cars, make sure to look into that as well, because there are certain time frames that you can take those credits as well.
Mm-hmm.
So if you did buy something like that, even though the car itself may not be depreciated in the first year, if it is less than 6,000 pounds, but if you're using those electrical cars, make sure to look into the other options as well, where you might get a better credit on top of what you already have. Now, the next one was actually to leveraging uh, tax preferred vehicles like infinite banking, retirement plans, those kind of stuff. And one of the things that you guys could essentially still do is, up until the point you actually file the taxes, is the self-employed retirement plans. If you have someone to take care of it, have it set up and say that, hey, we need certain amount of deductions. And if you don't need the money right away, maybe just dump a bunch of money out there and just keep it. What's your thoughts on it, Chris?
Well, Chris, actually, Tusif, I was talking to a client and telling them that, hey, this is something you could do. And they said, well, I'd rather pay the money to me than to the IRS. So really, it's who you want to do. But it's one of those things that not a lot of people take advantage of, that it's right there, it's for you, and it's something that can help you not only now, but down in the future. So really, and I encourage people that to really talk to their financial advisor and see what can be set up. So please take advantage of this.
Absolutely. And I guess this is more self-employed tax is more for LLCs and S corps. What do you think? Is this the same thing with S corps, or S corps are exempt on it?
No, you can have self-employed retirement plans with S corps. They're going to be set up differently, but make sure that you tell your financial advisor this is for my business that is an S corp, so they can make sure that it's filled out correctly.
Absolutely. But for C corp, you don't actually get always this, unfortunately, but you get other benefits with C corps. So
Absolutely, yes, yes.
so make sure to understand. That's why I always recommend, hey, whenever you're doing it, I actually sat down with someone today, where, of course, a lot of people say a lot of things about C corp, but when they hear that, hey, me being a tax professional, I'm keeping my structure as a C corp, they're like, why are you doing it? So, of course, I don't get those benefits, but the taste of financial uh, expenditure is different people. I personally prefer uh, buying real estate as opposed to just saving it for retirement plans. But however, it might be better for someone else. Instead of buying real estate, especially in this market, it might be difficult for them, and they would rather have it there. And in some cases, if structured properly, some of them can be taken loans against as well. Like
Absolutely.
401k, especially 401k itself, you can take loans against.
And then I would be different. I would prefer the retirement plan than the real estate because I don't want to deal with real estate. Tusif's a much younger man, so he has more energy to deal with all that. So
Absolutely.
I'm sticking with my retirement plan.
Yeah, so that's what I mean. There's nothing good or bad about it. It's just more about what your personal choice is. It's about, at the end of the day, our mission here is to allow you to choose between what you want to do with your money and not having to have someone else do it for you. So that's the whole purpose of this planning. Now, the other plans that we were on the following episodes, what we were discussing about understanding to gather the numbers, leverage the trust. If you are leveraging the infinite banking strategy, which is leveraging the life insurance, of course, it's a tax preferred vehicle, but you have to put post tax money with it. But unless you are, again, a corporation, that's what this play comes in, is I can actually have a write-off from my corporation if I'm actually having myself a life insurance. So if you're leveraging that, make sure you understand that. And also, one of the things that we actually talked about is understanding to read your numbers. Think like a CFO of your business. If you cannot, let's have a conversation. Maybe Chris and I can help out And in this video, I'm going to put both mine and Chris's calendar link on the description. So if you have any questions, feel free to reach out, book a call, and maybe sit down with us. Feel free to ask questions. And on those, especially what we recommended is understanding how to differentiate between year to year of your financial picture. And one of the latest one, I mean, before I actually get into the next one, Chris, I would love to get a little bit of your insight on the side of the importance with the tax, especially in these tax times, for someone to understand their own perspective of the business.
Well, so one maxim that we had always learned back in business school, back last century, I can say that, was that what gets measured gets managed.
Yes,
And people get tied up with, well, I need to have, they get intimidated by financial statements. And thing to remember is that this is not something that you do need to have it done correctly, but don't be intimidated by it, because if you have people putting it together for you, it allows you to see the story of your business so you know what moves to make. So someone has, well, your revenues went down, your sales went down, but your advertising went up. Okay, why did that happen? Did somebody sell you a slick program and said it was going to work and it didn't? Or your employees are working more, but your sales are down. Well, shouldn't that have brought in more money? It allows you to make decisions about your business. So it's not sitting there understanding, all right, well, I'm a CPA now and I can understand and why the rules are like they are. The rules are meant to funnel this into a way that you can understand your numbers. So to make a decision about where you want to take the business. That's all the financial statements are. They're helping you to understand this is what's happening in my business, so I know what to do to make things better.
absolutely. And of course, I would recommend definitely understand what and how your CPA or CFO coming to that number. But at the end of the day, you need to realize that your time is limited. And if you could look into 3, 4 key numbers and be able to make a decision, it's going to be way, way, way more efficient and much more productive than you going through the entire statements, financial statements, and coming to the same decision. So that's something that I would always recommend looking into getting for yourself and your businesses. And another one that we did discuss was especially if you had bought assets, 179 deduction, 197 deduction, or bonus depreciation, where you could actually even though they're a depreciable asset, you could take the entire depreciation in the same year. Now we are having rumors about the depreciation moving back 100%, 60%. Hey, Chris has been a CPA way longer than I have, and he knows how many times this thing has been moved back and forth.
Yeah, it's, you know what, if people ask me, well, what are they going to do? This is Congress, and people think, oh, well, they just operate in a vacuum and they're going to pass these. No, there's discussion going on and some little horse trading, as it's called. You know, folks, until they say this is what the rule is, don't do anything. Don't assume that this is what's going to happen.
Yes.
The bill that Tusa was talking about, they're talking about for the 2023 year. And when I read that earlier this week, I nearly had a fit going, okay, now you're messing around with something that's already happened. And it's really going to throw off a lot of the reporting that we have to do. So I wasn't particularly happy about it. And I won't repeat the words that I used here because it's kind of a family podcast.
Yeah, so definitely everyone is, I mean, here's the thing. At the end of the day, if it is 60%, 80%, 100%, you need to be prepared for the worst, but hope for the best. That's what my suggestion is. Hope for the best, but prepare for the worst. So that's what I recommend in that. And of course, before wrapping up, one of the things, since the CTA Act is out there, make sure to register your business with Corporate Transparency Act. I actually had one of the previous videos we spoke about. I actually have the link to it. make sure to check it out, register your business, and not have to pay about that $500 a day, that penalty as well. And last but not least, we discussed about what to give you for your tax preparers so that you get the maximum deductions. Chris, let's have your final words on that specific thing.
Well, as we talked about at the beginning of the program too, Steph, is ask the questions if you don't know what it's about. And if you get something in the mail and you're not quite sure if this is something you can give your CPA, give it to your CPA. Let us tell you, no, we don't need that. If you get it, like, well, no, you can file this with Aunt Edna's chocolate chip cookie recipe. We don't necessarily need it, but we will take Aunt Edna's chocolate chip cookies.
Yeah, both of us like chocolate chip cookies, especially when they're warm and just out of the oven.
Oh, yeah.
So anything else that you wanted to add before we wrap it up today?
Well, what I say is just be diligent. Work on this a little bit of time. I know it can be scary, but just work with your CPA, work with your EA, and ask any questions that pop up. And we're here to guide you and here to help you.
Absolutely. And if you're feeling that, hey, we genuinely need more time, and hey, we are getting delayed with the catch-ups. Sometimes life happens. We all of us understand. Make sure to have yourself or your tax professional file an extension for you. You get 6 months of extensions, which moves your extended dates from March 15th and April 15th to September and October 15th, respectively. So what it does is it does not stop the interest payments, but it does stop the penalties of late filing. So if you do file within that period of time, you're not going to be charged any late filing fee. But if you do file after that, then every single month you're going to be filed $450 or any taxes owed, whichever is lower. So if you don't owe anything, that's a different thing. If you have more money to IRS is probably not going to charge you so that they can give you money back. But if you do owe to IRS, make sure to file it. Otherwise, $450 a month is not happy to pay for nothing. So definitely, these are some of the last things. With that, we will be. This is going to be probably one of the last episodes that we are going to be doing together before the tax season ends. But most likely after that, we would love to start it again. We love enjoying talking to all the people. Chris, the last floor is yours.
All right, folks, we're looking forward to talking to you again after tax season, and any questions pop up, Tusif and I are available. We may be a little crazy in March and April, but we look forward to starting this back up again and helping people understand more about how to save money on their taxes.
Absolutely. And if you need filing in the meantime, hey, you still are going to have our calendar links. Just feel free to reach out to us as well. We're more than happy to help you out. I know these tax laws and filings might be sometimes critical for us. With that, appreciate everyone who has been watching. Appreciate everyone who has watched previously and will be watching it after on YouTube later someday. With that, thank you, everyone.